Corporate Finance, Core, Topic 7, Cost of Capital, Learning Objective number 3. We're going to be able to estimate the cost of debt for a company to use in that weighted average cost of capital. So we're going to look at 4 different methods for calculating cost of debt. We're going to use the average yield on the firm's existing bonds or loans, use the average yields on firms that have similar risk characteristics. We're going to use a historical interest expense, and we're going to use marginal debt financing costs. So the first way to calculate the cost of debt, KD, would be, and I'm going to use Walmart as an example, is I can go to, say, Morningstar.com, or if I had a Bloomberg available to me, I'd use that, and I'd look at Walmart's existing long-term bonds. So I went to Morningstar, and I looked at the average yield of some of their long-term bonds, the yield to maturity, and I got 3.76%. So you can just use the average long-term yield of their corporate bonds. A second method is to not look at Walmart specifically for the yield on their bond, but find the yield for long-term bonds for firms that have similar risk characteristics. So Walmart is a AA rated firm as rated by the S&P Credit Rating Agency. And you can see the credit agency, they're rating the corporate bonds and what they're rating is their ability to repay the loans. In other words, what's the probability of a company defaulting? And what they have is the highest level bond, the ones that are least likely to default, are AAA. Now, Walmart happens to be a AA, which is a very high rating for a corporation. It's considered high grade bonds. You can see that the rating go from AAA to AA to single A to triple B and so on, all the way down to D, which is in default. So since Walmart is a AA rated firm, I then use that information at Yahoo Finance Bonds, and I found that the average AA rated company has a yield on their bonds of 3.87. So I'm going to use that for Walmart. Another way to do it is to just go to the income statement and balance sheet. Just take last year's, say, interest expense and divide by the ending debt balance or the average debt balance for the year. This is generally not the preferred method, even though you think like what you think the historical data would be the best. However, the problem with it is not forward-looking, and also we don't know exactly how what the characteristics of that debt was. Maybe this is all short-term debt that was about to be refinanced into long-term debt. So maybe that has a very low interest rate last year only because they had very short-term debt. Or maybe the debt that they had was something special provisions in the debt. Maybe it was convertible bonds that could be converted into stock later, and so it had a very low yield on it. Or it's callable debt or something called puttable debt. So there are characteristics that make bonds more or less expensive or higher or lower yield. And you just don't know. Also, if you look at the interest expense on the income statement, it just shows you it's really the net interest expense. You know, what if they're also holding some securities, gaining some interest? So there's interest income mingled in there. So for this reason, I'm generally not going to use this unless I have to. The last method is if there's some information, and this is actually a clue on the case study that we might have later, there might be information about a bank has just signaled to them that here's the latest rate we'll give you in financing a new project. So you might get information about a current or expected line of credit rate. Or you might get information that a bond, the latest bond to be issued by that organization had a particular yield. Or you might get information that a bank is currently lending to the company at some percent. So that actually would be very useful because that's really talking about kind of the marginal financing of the firm, the kind of incremental financing of the firm, what kind of rate they're going to have. Now for Walmart, I'm just going to use that AA rated yield of 3.87, and that's what I'm going to use to calculate the Walmart's WACC. All right, so this topic we calculated the the cost of debt to use in the weighted average cost of capital.